Earned Income Tax Credit, the EITC Tax Preparation 2020. The Earned Income Tax Credit is one of the most complicated tax credits to understand and calculate. We'll take a look at it here in a practical way using the actual forms and software. We'll take a look at the Form 1040. We'll run different scenarios related to the Earned Income Tax Credit, which can be seen on page 2. So the page 2, we're looking at line 27. That's going to be the Earned Income Tax Credit, the EIC. First of all, note that because the Earned Income Tax Credit is quite complicated, you do want to use software if you can use software in order to help assist you to calculate it and or have a tax professional to help you with. But if you can get the software, the interview process is really helpful. So we're on the IRS website, that's at irs.gov, and you can get access to software by going to the free file. So go to this file your taxes for free, or you can search up top for file taxes or free file, and that'll take you to a link here that will give you suggestions for third-party proprietary software such as TurboTax by Intuit and so on. If you qualify for the free portion of it, then you may be able to do your taxes for free. Just remember that when you're looking up those softwares, these will then be pointing you from the IRS website to the third-party software. If you want them to be calculating the Earned Income Tax Credit, make sure that they're including that in the package. Then you can use the software to do some of these calculations. Now, the Earned Income Tax Credit is one of those credits that if you don't owe any taxes, you still may want to file. So just remember that if you're looking up and thinking, well, I didn't make a lot of income in 2020, maybe I don't need to file. You might be asking that question to yourself and thinking, maybe I don't need to file. Just remember that even if you don't need to file, you may still want to file. So if you look up whether or not you need to file with the IRS, typically if you do not owe any taxes, and that would result if your income was less than, say, $12,400, for example, which would be the standard deduction, then you may not need to file your taxes. That just means the IRS will not come after you if you don't file your taxes. It doesn't mean that you may not benefit from filing your taxes. The main things that you could benefit from are the withholdings that you have, even if you have a little bit of income. If it was earned income, W-2 income, you may have withholdings. So that would be on page 2 here. So even if your tax liability was 0, this is close to 0 here, you might have some withholdings. So that might be worth filing. Even if your withholdings were very low, then you might have the Earned Income Tax Credit or access to it. And you might have the additional child tax credit, some of these refundable credits on down below. You also might be wanting to consider the recovery rebate credit, which is kind of the complement to the economic impact payments if you didn't get the full economic impact payments. So that means that you may still want to check it out even if you're not required to file, and you have software now that can help you to do that and test some of this stuff out. Now I'm using LaCert software, which probably isn't what the free software that will be out there, but you can do similar kind of testing with the other software, which will be in kind of an interview type of process. Our focus here is going to be on the Earned Income Tax Credit. I've kind of maxed it out at this point, so you could see that, but I'm going to go down and break it down to its components now. We'll start off with a single filer and no dependents, and then we'll kind of build it up, and you can see why this credit is a little bit complex, meaning it's complex, for example, because as your income goes up, the credit actually goes up. So if you want to think about how the thing works, one of the best ways to do it is just to test different income levels so you can kind of get a feel for what the credit is doing. You can visualize a curve in your mind. The credit's going up, and then at some point it's going to be going back down as your income goes up. Also, it's going to be dependent in some form on how many dependents you have. So that's another factor that you need to be taken into consideration. Also, this year they added some new thing where basically you can use 2019 income if it would be beneficial for this credit as well. So we'll take a look at that too. So let's bring this back. So right now to max it out, we're at a single filer and 3 dependents. So let's cut the dependents down to 0, and let's bring the income down actually below our threshold and then see what the credit would be first off. Starting point here, we're going to say single filer Eric Smith. This is a fake name and social security number, living in Beverly Hills 90210. We've got the wages at the $10,000, and then note that that's below the standard deduction, which is $12,400, the standard deduction that everybody gets, and therefore most likely may not be required to file. But once again, because they're not required to file, doesn't mean you may not benefit from filing, so you might as well check it out with the free software. We're going to then go to the second page if you have access to the free software. And you may if you're under a certain adjusted gross income threshold. We have the tax line here. No tax is owed. And that's why the IRS is saying, hey, look, we're not going to come after you if you don't file your tax return. You don't owe any taxes, right? But down here, if you made any withholdings, which we said we made 100, that's going to be refunded to you because you don't owe any taxes and you paid in 100 through your employer. And then down here, we have the earned income tax credit. I'm not going to get into a lot of detail on the calculation. We're just going to do a trial and error with the software. Note, disclaimer here, I am depending on the software basically to do the calculations here. And so, what I put into the software is helping me to calculate out the data input. But you can go through the calculation here and look at the scenario for it. So now we can see it's fairly low because one of the major factors involved are going to be the qualifying children. So if you add the qualifying children, it'll go up. So you don't need a qualifying child for this credit, but the qualifying children have obviously an impact up to 3 will have an impact on the credit increasing. Notice here we're at the income of the 10,000, so 10,000 on the income. And notice as the income goes up, as the earned income goes up, then the credit actually increases. So in other words, if I was to say take the income down, for example, let's say it's at 443 right now, and let's say I only had 5,000 of income this year, 5,000, and I'm going to go back over. I'm just depending on the software. Now it's at 384. Let's say I bring it down to like 2,000 of income, and let's bring it over here to 2,000 on the Social Security income as well. And now it's at 155, right? And so this is kind of counterintuitive. This is kind of the opposite of what you would think a refundable credit would do, but it's trying to not disincentivize people from, if you earn more income, then you just get cut off of the program, right? They're trying to have it do the opposite, basically. So you could see it going down as the wages go down. If I bring the wages far up over 10,000, let's say 15,000, now we're at only 61. So you can see it went down from the 10,000 here. So we went over the cap, and you can imagine a curve humping at the top and then going back down. So 10,000, when we were at 10,000, it was higher. It's at the 443, and then if you go up to 15,000, it's going to start going back down. So you can see how that kind of works. And then the other factor that of course would be included here would be a qualifying child. But before I get into that, just also note we've got this funny thing this year where you might imagine like you're in a situation, maybe last year you had 10,000, let's say. And that if I was to calculate it using the 10,000, I would be at the 443. But let's say that this year in 2020, you only had let's say 1,000. Well, that means that you have less earned income. So if I go back on over here, the credit's going to be a lot smaller. But I can actually use the 2019 income, and this is kind of a funny thing here. So if I jump on over, this is new. I'm going to say, let's go to other income. And if I was to say, okay, in 2020, I had less income, but I'm going to say for the purposes of this credit, 2019, I can actually use 2019 if it was higher and beneficial to do so. So I'm going to say the 2019 was that 10,000 here. And then if I jump back on over, see what it does is it says, hey, look, I'm using prior year's earned income to calculate the current year's credit. So you can kind of use your software then. That's a new thing for this year. You can use your software to kind of see what the credit should be. It's not enough just to see whether you qualify for the credit or not, because obviously the credit itself fluctuates a lot based on the earned income. And you can also test prior year's earned income because you can use 2019. The thought process for the government, and this is my interpretation of what it probably was, is, hey, look, people may have more earned income last year, and then they got completely crushed this year. Their whole career and their whole business was crushed in 2020, right? So they don't have any income in 2020, but we still wanted to give them the earned income tax credit because that's not really anybody's fault at that point. So we're going to give the option of having the 2019 income if the 2019 income was higher than the 2020 income. So that's the thought process there. So I'm going to bring that back out. I'm going to say, all right, let's bring it back to just using the 2020 income. So there we have that. So now we've got the 78 as the credit, and now let's say that that we have a qualifying child. Let's start adding the qualifying children here. So we're going to go to the dependents, add a qualifying child. So okay, we've got Tom Smith is a child, and that's going to be the born 010120. Social security number, I'm just making this up, is that, and son. So a qualifying child and dependent. All right, so we're going to say, all right, back on over and take a look at the credit. Now the credit's up to that 349. So once again, scenario, if I go to the first page now, what's the scenario? Married filing, single, I'm sorry, not married, single. It's going to be Eric Smith, living in Beverly Hills, 90210. We only got the 1,000 here, but now we have a dependent. So the income is only 1,000, which of course is way below the 12,400. Therefore, no taxable income and no tax being calculated. But we still have the $100 withholding to come back, and then this earned income credit at the 349. Now let's focus in on our income and say, okay, let's bring the income back up to, let's start to increase the income and say, okay, now we got one dependent. What does that do? I'm just dependent on the software here. I'm just gonna say, well, I don't know. What if we made like 5,000? 5,000. What's the software gonna tell me the earned income credit is? We're gonna say now it's bringing it up to 1,709, and I'm gonna say, all right, well, what if it was like, what if the earned income was like 8,000? And so we'll say 8,000, 8,000, and bring that up. Now it's up to 2729, 10,000, 10,000. We're now at the 3,409. Let's say we go to 12,000, 12,000. We're now at the 3,584, 3,584, 15,000, 15,000. And now we're at the 3,584, so we've kind of hit the plateau here. Let's say we're at 18, let's say 20,000, 20,000. And we can see we're at the 3,473. So now we're going back down, right? Let's say 25,000, 25,000. And we're going to say, all right, now it's at the 2,678. And let's say we get up to 30,000. 30,000, 30,000. Now we're at the 1.8. So you can see it, if you're imagining the curve, as the earned income goes up, and then it goes back down, right? That's why you might want to use 2019 earned income if it was higher, and you're basically reliant on kind of the credit here for a benefit of it. Now, if we added another child, let's bring this back down to like a baseline of 10,000. Let's say we got 10,000 of income, and just keep it there as our starting point. And so now we've got the one child, 10,000, 3,409. Also note you got the child tax credit. It's a refundable credit as well. We're not focused there, but that's the other one that you can kind of imagine that would be possibly applicable even if you're below the filing threshold. So let's go down to the dependents again and say, well, what if we had like another child? Like, what if we had like Jane Smith, and Jane Smith was 010119, married or born, and the number, I'm just making this up, is going to be that daughter, and there we have it. So now we got another dependent. So let's go back on over, and we're now at the 4,010. If I go to the first page, what's our scenario? Single, and we've got the Beverly Hills, living in, 2 qualifying children, Tom and Jane, 10,000, below the 12,400 standard deduction. Going then to page 2, no taxes owed because there's no taxable income, but we still have the withholding that should be coming back. And now we've got the the earned income credit at the 4,010, and then we of course have the additional child tax credit as well. So then let's go back on over and start adjusting. This was that 10,000 of income. Let's go back on over and say, all right, well, what if like we had 15,000 of income, and we're going to say, okay, now we're at the 5,920. What if we had 20,000 of income? 20,000 of income. And so the software's saying, well, then we're at the 5,774. And then I'm going to say, all right, what about 30,000? 30,000 of income. And it says now we're at the 3668. So we're going back. We've gone back down, right? Let's say 35,000. And so now it's at the 2615. Let's say 40,000. And now the software's like, now it's at 1562. And let's say, all right, what about 50,000? And software says, done, you're done. So we had the 45,000. Let's bring it back down and say, well, what if we added like another child? Let's bring it back down to 10,000 again. And we're going to say, all right, so now it's at the 4,010. What if we add another child? We're going to say, bringing on another one here. Another one, just like the other one. So this is going to be Sam, and born 010118. And this is going to be Son. And so there we have it. And so now we got 3. So if I go back on over, so now we see the change at the 4,511. If I go back to page 1, scenario, single, Eric Smith, living in Beverly Hills, 90210, 3 kids, Tom, Jane, Sam, all child tax credit qualified children. So we got the 10,000 income below the 12,400 standard deduction, no taxable income. Therefore, page 2, no tax is going to be owed, but we still got that $100 that's going to be coming back from the withholdings. We've got then the earned income tax credit at the 4,511. Let's start adding the income now. So we're at 10,4,511, and let's say now like we have 15,000 income, 15,000, and go back on over. So now we're at the 6660, and then let's say, all right, well, what if I had like, 17,000, and so now we're at we're plateaued, and then let's say we had 30,000 jumping up to 30,000. We're gonna say then software says 4,408. Let's say, all right, well, what if we had like 35,000 and 35,000? That's 350. I can't stop putting. Okay, software says we're at the 3355, and then let's say we got the 40,000. Software says we're at the 2,308. So there's the 3 kids on that scenario. So you get the kind of idea. The next thing you could test, of course, is the marital status. You can say, well, all right, well, what if the other, what if they were married? What if we've got married, Eric's going to get married to Jane, which is also the name of one of the kids now, I think. I named the kid one of the, anyways. So let's go back on over, say now married. And so now we've got scenario, married, filing joint, Eric and Jane, living in Beverly Hills, 90210, 3 kids, Tom, Jane, Sam, 40,000 on the income, 24,800 standard deduction because now they're married, right? So the standard deduction 24,800. Going then to the second page, we then have some tax calculation, and now the earned income tax credit is at the 3,542. So let's say the income 3,542 at 40,000. Let's bring it back to 20,000. 20,000 for the married, and that now it's at the 6660. So we're plateaued at the 6660 there, and let's say the 30,000, married, filing joint 3. That's the 5. It's going back down from that point. So you can kind of test out, and you can see how you can kind of test out the software here. Check out 2020 numbers for your gross income, 2019 numbers. You can see that it's a lot more complicated than just qualifying for the credit, because the credit fluctuates a lot depending on your income level, marital status, number of dependents.